Well, GM, everybody, and welcome back to another show with Centaura. Look, we've got a ton to cover today. I'm really excited about it, honestly. We've just been speaking to Anthony a little bit before the show. A money system built for the next generation is the title of today's show, and we're going to talk about why this is the time to build it. Like, what is going on, what the numbers are, and how the system is currently built, and is it really ready for that new generation of owners of so much of the finance of the world, like so much of the actual percentage of the finance in the world. And Anthony even has had his typewriter back out or his notepad. He's been writing again. So we've got a really cool document to go through as well. I'm really excited about diving through that. It's going to be a really good educational episode. If you're in DeFi, if you're in finance, if you're in investments, then I think this is going to be one that really makes you think a little bit more deeply of what is going to happen over the next 5 or 10 years and potentially even adjust accordingly. Anthony, do you want to intro yourself, Centaura, and then we'll dive straight into the convo?
Sure. Anthony DiMartino. I'm the CEO of Centaura and the CEO of Firelight. I had a very interesting path into crypto. I was a trader on Wall Street between UBS, Barclays, and HSBC for over 20 years. Decided to get into crypto by joining Coinbase and building out their DeFi and derivative team, and then started a company called Trident, which merged into the block that formed Centaura. So I think the Centaura is a firm that has 5 different core disciplines. We have smart contract engineers, AI developers, risk managers, traders, and product people. So it's a really interesting mix of talents in the space, and I think it allows us to tackle some of the bigger structural shifts that are happening in the market, which we're going to talk about today.
Absolutely. And I think, look, there's this document. I'm actually going to switch screens now to start highlighting this. And let's just go back to the homepage. Liberation of Money, the Dollar Reimagined. So this is a document you've written yourself. Talk me through what made you write this. You mentioned offline that it's been a little while since you started writing. Now you're getting back into the flow of things. Tell me a little bit about this before we dive into each page and what it means for investors and for the world.
Yeah, so I think most people know that we're going to go through the largest generational wealth shift in the history of the planet. As the silent generation and the baby boomer generation is going to pass wealth to younger generations. I have the unique positioning being, too old and too young at the same time to be in crypto, but where my parents are the generation that is going to distribute the wealth, and in all reality, people are living a lot longer. That wealth is going to bypass me and go to my kids, right? So, and then when I think about how their generation looks at money versus the younger generation. Now, this is where I'm too old. I have 3 kids, 20, 17, and 14. And I was discussing money with them and how do they think about it. And I had previously had a conversation with my parents. And what you realize is that while the wealth is transferring from one generation to the other, the demographics are completely different. I feel my generation is probably very close to the baby boom generation as the way we think about money and wealth. But if you take this younger generation, they're completely different. And I think, one of the triggers is my parents' generation trust the banks implicitly. They like to talk to a person. They like to pick up a phone. They like to walk into an office. The younger generation, bears the scars of the global financial crisis, right? Now, they weren't, that was now 2007, so we're talking 20 years ago almost. But they weren't impacted directly. They weren't even born yet. But their parents, who were who were graduating from college when that happened, were trying to accumulate wealth, were trying to buy a house, were deeply scarred by that incident. And it created a distrust of banks that's been passed down to this young generation. So on that spectrum, you couldn't get 2 groups of people that are completely the opposite end of the spectrum, right? So I think most people think about this money transfer, and there's some statistics. It's 38 trillion in the next 10 years, 124 trillion in the next 20 years. is a monumental amount of wealth is transferring. But I think most people think about it from an investment standpoint, which it is going to make a lot of different, that older generation, if you even follow anywhere near traditional asset allocation, is buying treasuries, right? Because they just need income, they need to survive they need cash. They're not betting on SpaceX, right? But the younger generation is kind of getting forced into this, like, has to take more risk, right? Because salaries are not even keeping up with house prices, equity prices, everything's getting more expensive, inflation's not going away. So you're taking, from a risk perspective, you're taking money out of zero risk hands and putting it at uber risk hands. And I'm not talking about being reckless, I'm talking, if you're 20, your investment profile looks very different than if you're 70, right? So, and then I go a little bit deeper about how they're going to handle the cash, right? The dollars. And that's also very different. I mean, I think my parents still try to go get traveler's checks when they cross countries. I think most people on this phone wouldn't even know what those are, right? They go get cash out of an ATM, right? I don't even use a credit card anymore. I use a phone. Like, and like, we need to find a better way to get your license, and I would never have a wallet, right? A physical wallet. So how the kids think about the money, and this was a conversation with my 14-year-old daughter. She has a Venmo. She's always had a Venmo account, but now she's had a Venmo debit card. And we've convinced the family and friends to, when they give her gifts, don't give her cash, send her a Venmo. And when her and her friends go get pizza and they split the bill, they send Venmos. And now when they go and buy things, they use their Venmo debit card, which is, by the way, already in their Apple Pay. So the thought of them going into a bank in 10 years just seems like such a low probability outcome based on the way banking products that haven't really changed in 100 years, right? So I'll stop there. Just kind of, I know I took a long-winded entrance, but this is just observations before we get into the meat of this.
I'm really excited about this. Obviously, you're talking essentially about me as well. Like, I came out of college at, I think it was 2011, which basically meant 2008 was in full swing. Like, people think of 2008 as if it was like this immediacy, and of course there was, like, in terms of the global economy, but in terms of how it impacted work, it wasn't like the next day everybody was just out of jobs. It took a while for it to hit the job market, and I think, at least from memory, 2010, 2011, 2012 was where you really started to see the knock-on consequences to that in every industry. Like, you were not safe. You couldn't hide anywhere from the consequences of this. I had friends doing plumbing who they were working for companies like Balfour Beatty and the biggest companies on the planet in construction, thinking they just landed a really good, safe job. Everyone needs to build. Construction just stopped. It just stopped dead. And what a lot of these bigger companies did was they essentially forced people's hands and said, hey, look, you can still work for us, but it's not going to be on a salaried basis anymore. You're a subcontractor now. It was the decade of subcontracting where you're still expected to be paid in the same way that is provided to you with the safety and security of an annual salary job, where you're going to work hard, and over a lifetime you can stay at that job. However, you don't get any of the security anymore because we can't afford to. What if we don't get the next job? Or what if construction stalls again? Or what if 2008 was just a sign of what more there is to come? There's still all this uncertainty. And I think absolutely people around my age, a little older, especially a little younger now, they look at what caused all of this, and they still blame the banks. They still blame 2008, the financial crisis, the idea that the people we thought were in control of the money and they were qualified to be in control of the money and they knew what they were doing, fundamentally did not. At least that's what The Big Short led us to believe. At least that's what, these like big newsletters and the media coverage and everything, it shifted very quickly to, hey, this was actually the bank's fault. A lot of these companies didn't know what was going to happen, and they off their books once they realized, and that's why there was this big delay, all of this stuff. So yeah, you're sat there thinking, oh, okay, now that this money is coming to me or my kids, I'm going to give that to the same institution that is essentially, at least if the media is to be believed, the culprit to why it's been so difficult for me to step up in my job, why it's so difficult now with inflation to work in the same way, where you used to just be able to work really hard and that was enough. It is, the time is gone where working really, really hard in a job and for a career will mean that come retirement, you're going to be good. I don't think that exists anymore. And I think that speaks a lot to the risk appetite and the risk nature of these younger people now, because they know that's not the case. They know they need to find another source of revenue to sustain them in later life. Otherwise, they're just seeing that their jobs aren't keeping up with buying homes, as you said, with groceries, with rent, like not even buying, just literal survival, like roof over your head, food that is coming in, and honestly transportation or, you know, air conditioning, whatever. Like these are things people now have to consider rather than just take as a fact of life. As long as I work hard and I get a steady job, I am guaranteed at least these things. More than that, no, that maybe I do need to start my own business, or maybe I do need to invest. But a roof over my head, air conditioning that I don't have to worry about the electricity bill for, good food on the table each day, exercise, like I think that now is becoming less and less of a guarantee in life. So, Anthony, I'll throw it back over to you here. Is that the mentality you're talking about here?
Yeah. So I think. So thank you for validating the boots on the ground view. Now I think so. It's all nuance, right? So people keep using this term K-shaped recovery, K-shaped growth. Like, you know, and basically what that means is that there's no singular trend line for growth anymore. It's either the wealthy get wealthier and the poorer get poorer. Like it's this constant diversion of growth. So there's a couple observations generationally that most older generations think younger generations are reckless with risk. Now, on the surface, that's hard to debate because, you know, we've basically gamified everything, right? Think about the biggest products in the market right now, not just in crypto, but in TradFi. Prediction markets and leverage, right? Futures, triple levered ETFs. I mean, if you're dialing in from Korea, I'm sorry. If you've seen what's happened in the Korean market over the last month, you know, leverage. And so why do people take leverage? So people take leverage because they're reckless, or they realize what you just said. You know, there's two outcomes. And if the outcome of working my whole life in a good job and saving money doesn't get me there, then it's not reckless to take more risk, because just sitting there doing nothing means you're going to have a shortfall, and it's very, very clear to people. So there is a portion of the population on the lower income spectrum who are clearly taking much more risk, and the probability of them losing is still high because it's still a casino represented in any other form, a bank, the markets, they're all some form of a casino, and the house always wins. So, you know, some people will get out that path, most won't. The people who are sitting on the higher end of the K spectrum, like that are making good amounts of money, something was really, it's in the first page of the articles, the rate in which the younger generations are saving is almost 50% higher than their parents' generation is saving. So they're actually, the portion of the generation that's actually making solid incomes is actually saving a lot more. The other thing that was really interesting is the savings rate is at the lowest it's almost ever been, even though interest rates have been volatile. Like the average checking account balance is 40 basis points. So you get to this point where you're saving more, but you're earning less is a growing problem, right? And this is why you think every neobank is now offering a yield solution, an earn solution. All this is becoming important because the banks are just, you know, they're benefiting. The split of benefit that goes to the bank versus you on your own money is getting so egregious that it doesn't make sense. I'm going to just throw a random fact that's not in here that I saw today because I'm writing a whole credit supercycle article coming out next week. So just doing background. The average age of a first-time home buyer in the United States is 40 years old. Isn't that crazy? Like, I don't know what it was before, but I'm assuming it's got like a 30 handle, like 31, 32, 33, 40.
Well, if you just think, when should you live on your own? Like, if you just, not talk about like any specifics or logic, or like when are you an adult and when should you leave your parents' home, or when should you be looking to own a home? It's like, I would say, even because I agree, there's probably been this like shift where the maturity is shaken out a little bit. So I don't think it's as young as it was 100 years ago, 50 years ago, even. But I would say 25. 26 maybe, or you should really be looking, maybe that's rent, maybe,
Right.
but like that's really when you should be moving. And obviously if you're earning a good enough salary, you should be looking to buy over rent, or at least that's been the narrative for the past 50, 100, 200,000 years. So yeah, that's the fact that it's 40. I don't think that is a reflection of choice. That is purely a reflection of the times we're currently in, and how much a lack of a choice there actually is for those age groups, whether you want to say it's 26, a bit younger, a bit older, all the way up to 40. I think they are stuck. That isn't a decision they are making. They are stuck not being able to buy their first home. That would be
Right.
my sense.
It's particularly scary for me because I have three teenagers.
Yeah.
So I was hoping, my parents were like, once you turn 18, you're out. Figure it out. Go to college and then figure it
Yeah.
out, right? And it's just becoming, it becomes a strain across the board for the people that needs to support them and them having their own independence. But 40 years old, man, back in the day, people were starting to look at the last mile towards retirement. Now you're sitting there going,
Yeah.
I'm just getting on the wealth scale, right? I'm just getting on the treadmill at 40. So
40 years old is the final home. That should be, I've had kids. Like, we're in the family home now. This is the
Yeah.
one that the kids are gonna get. Like,
Right.
we're gonna pass on generationally. So yeah, that's a wild
Yeah.
statistic. I think another statistic, coming back to the document, and anytime you want me to surface the document in a larger scale, Anthony, give me a shout. But I think the average US savings account paid, this is directly from what I've seen, 0.4%, whilst the Fed paid banks 176 billion on reserves. Explain that gap to me and what it means to, a young saver with like 20K in the bank. Like, it's just
I mean,
0.4%.
there's no like mathematical justification. It is
No.
what people are paying in trust, right? Like, it's the trust tax. They should be earning, if you're earning just a pass through of treasuries, it's 375. So the banks have calibrated that if I pay you 40, that you're not going to leave, and they're just going to keep pushing that down until they see people leave. And I think that's been the explosion of neobanks, different types of payment company, everybody issuing a debit card, payroll directed debit cards, earned wage access because people living paycheck to paycheck, they need that money sooner. And this is probably the most, like, what made me angry, which typically when I creative in the morning, I wake up choosing hate. And this was kind of the expression of that hate. Is take a PayPal for an example. When you Venmo money from one wallet to another, if the money's already in Venmo, it's free. It happens instantaneous. When you Venmo, let's say you have $100 in your Venmo and you owe someone 200, it'll send the 100 and then draw from your bank the other 100. On the front end, it's moved instantaneously. But what's happening in the background is then PayPal is going to your bank and borrowing your dollars at 5%. Now, I'm making it overly simplistic. They issue debt or they use retained earnings. But my point is that what actually looks like a fintech revolution is actually just an old bank loan and a decent website. And this is all a fintech. You go through, think about remittance companies. When you go into your Marks and Spencers and give it to MoneyGram or Western Union, your uncle in Mexico City shows up immediately, right? But that doesn't move immediately. So what happens? Western Union borrows the dollars from the bank, right? The bank who's going to settle that cash in 3 days is earning the interest on the dollars that they're lending to you, and then they settle the payment. And guess where the bank gets that 6% they're lending to Western Union at? Right? So essentially, your 40
Now I'm
basis
angry.
points, your 40 basis points is just feeding these features that you believe are an innovation. And I'm not trying to knock on the fintech space or anything, but like
It's literally what's happening, right? Like,
right.
it's
So
logic.
the premise of liberation of money is like if you draw a diagram, right? So I'm the user, my money's down here, and I give it to a bank, and then I consume a feature that the bank finances. So me and my provider are here, but both of us are paying a tax to the bank on the same dollars. So now that everything's on a digital ledger, everything can use. The real innovation of crypto over the last 10 years is not meme coins. We'll leave perps out for now. It's not Bitcoin trading. It's wallets, blockchain, vaults, and stablecoins. That's infrastructure, right? We need to come up with a different word that's not crypto. It's financial infrastructure.
Yes.
So if these fintechs start to adopt this, what Centaura is trying to build at a high level, and we can get into the individual structures, but conceptually what I'm trying to do is take this triangle and make it a direct highway, right? So where someone who's long excess cash from their payroll provider. So let's say you're a client of Deal, and you receive stablecoin payments as a contractor in your wallet, and Deal surfaces, hey, you can earn 4% on your money. That's awesome, right? On the other side, if that money, that yield that's being generated, is a loan to PayPal to settle an ACH payment, or Venmo to settle a movement from the bank, or Western Union to pre-fund a delivery of cash, all almost zero risk exposures. What ends up happening is the user gets 10 times the yield they were getting. The provider costs go down, right? Which either makes them more money as a company, allows them to grow their services, or pass some of that savings back to you and create more competitive products. And if we can get out of this triangle and move it to a flat line, basically the only people get hurt are the shareholders of the banks.
I get that the way the banks are currently operating is just seeing how far they can move that line. Hey,
it's like how
trust is
everything's
worth
priced.
X amount.
Right?
Yeah.
Why do
Like,
people pay
it's-
$1,000 to go to a concert? Right? Because somebody else is willing to pay
because
it.
they're
Right?
willing to pay it. Yeah. But it feels extractive still. Even though logically I get it. I get why they're doing it. They're allowed to do it. They're testing the waters. There's enough customers for that scenario. I do think when it comes down to finances, this isn't a choice product. This isn't a concert ticket. This isn't something that I say, oh, I'm really into Taylor Swift, so I'm going to pay that money because everybody else who wants to go and see her, that's the line they have drawn. They'll pay up to $1,000, and therefore I'm competing with everyone else. It's a free market. When it comes to banks, interest, finances more generally, this is how we live. This is how we get food. This is how we put roofs over our head. And I think that comes down to this like millennial Gen Z psyche where it's just like there is something more polarizing than free market or the logic that they can do this because that's what people are willing to accept. It's like, I don't know if that's true. I don't know if it's people are willing to accept it as opposed to they don't feel they've got anywhere else to go. And it's more of a stranglehold. It's more of a monopoly type acceptance than it is, hey, I feel this is fair and this is how much I'm willing to pay for the security of holding it in a bank where I don't have to worry about my money. I don't think that's the
we're here to
that's the
stoke
full
we're
process.
we're here to stoke the fire to build the anger up so they'll finally get angry enough to make a change. And I think you've seen explosive growth in pockets of fintechs, right? You think of neobanks and debit card issuers, payroll companies, earned wage access, remittances. This is all these services are getting consumed at a larger scale. Now, the products are still inefficient because they run through the banks. And one of the things, and I will not name any fintech directly, but guys, you have blockchain, you have stablecoins, you have free off ramps to fiat. The amount of adoption of this technology, because it's the stigma because it's wrapped in crypto, a lot of traditional companies will die if they don't move. And the inertia, again, I'll choose hate again this morning, is so frustrating. Where you're like, I can cut your cost of financing in half. I could take you from being a fintech that has a balance sheet to a fintech that has no balance sheet. What does that do for your stock price? You're a startup. You don't have access to debt, so you can't operationally grow past how much cash you have on hand because you have to settle payments. I can give you a feature that lets you grow 10x. The latency on adoption of things that are so core to how money is going to move is frustrating. So the products that I outline going forward in this document are a bet that, for a less eloquent term, these guys get off their ass and they start adopting, because we do live in a competitive world. The first person that takes, at scale and at trust, takes the savings rate to 4% is going to decimate many other competitors. The ability to take borrow rates down by half is going to decimate competitors. The ability to get rid of this takes 3 days to settle payments is going to decimate the old infrastructure. I guess my question is then, are people like overpaid or not motivated to do this? Because it's every single one of these legacy fintechs are just sitting on their hands. Like the lack of and you could say it's clarity and you could say it's genius, but no one in the world is going to come for you if you move money on a blockchain rail with a regulated stablecoin and a non-custodial wallet, right? I think we need to usher out these old compliance teams that have either not kept up with the technology or too lazy to understand it. These people are cancers within these companies. They need to go. Right?
Do you think any of it is the fact that these fintechs are still in some way owned, when you go high enough, by the same people, where that infrastructure, those rails, are what is still feeding their bottom line higher? You
mean I just want to make sure I only offend people that are not clients. Are you saying that like Jamie Dimon and the CEO of XYZ payment company play golf at the same club and live in the same neighborhood as a reason for why this is happening?
And actually,
it isn't that hard. It's not that hard to make that jump.
I would go even further than that, where there's a financial reward for not doing it that way. I think that's, because otherwise, why wouldn't you eat their lunch? Like, there's got to be.
I mean, listen, I'll make a comment, and my parents are in that generation, but that generation is the most extractive generation of human beings on the planet.
Yeah.
Right? And they're going to, like anyone else, any incumbent, they're going to fight for dear life. Like, why are the banks pushing against Clarity and Genius? Not because Bitcoin trading is gonna kill someone, or meme coins are going to just, they're going to hoodwink too many retail investors. They're going to lose the payment system, which is the cash cow. Right? Look at JP Morgan's earnings and see how much comes from net interest margin, which is the difference of what they pay you versus what they use the money for. You want to get angry, look at that number. Citi, Bank of America, Barclays, JP Morgan, like go through that list of, they present themselves as big dynamic bankers and traders. The gravy train is from underpaying you for your cash.
But like 2008 happened, right? Like that's logically, like this whole article that you've written, that pitch, that sale, that is not gonna land to a millennial. Nobody, all the names you've just given, if they say, "Hey, we're doing this for you. We're doing this because too many people are getting ripped off by meme coins," or too many, not a single millennial or younger. I would even say probably a little older, because people lost their jobs at 40, 45 because of the same thing. The prime financial years, they're going to look at these people and say, aren't you guys the same guys who said that in 2008 the housing market was super secure? And at the same time, we realized you were offering your books like crazy to retail investors to not basically fall short. And then the government still had to bail you out. So, at what point, I can't see that narrative holding on much longer. We've got that 20-year period. And it's not like 20 years is like it's a button that gets clicked at the 20-year mark. Every single year, more of those finances are going to shift to people who've been hit by these companies and don't trust them the same way. And that shift eventually, I think, guarantees this sort of scenario where, yeah, the 0.4%, people balk at it and they say, okay, let's explain that. They listen to this show and they say, this all makes logical sense to me. I already have a little bit of a mistrust because of what has happened before. I believe that this scenario makes sense. How does this propose? Because obviously we've got the proposal here, liberation of money, the dollar reimagined. How does this proposed new model flip that ratio to 90% for the user? We've talked about what they do and how they extract. How does this model work differently, and how do we actually get to those numbers?
I'm trying to. The document goes into very specific features that get unlocked when you start. I think as a summary term, when you start custodying your own assets.
Yeah.
Right. And self-custody, initial gut responses, I don't want to, I could get scammed, I could lose all my money, I don't have anyone to call. That's not what I mean. What I mean is, if you think about your financial life, you have a bank that's typically not the bank you have your checking account in that owns your mortgage. You have a bank where you have a checking and savings account. You have an investment account because you typically don't invest at your bank. You move it to a brokerage shop to buy equities and bonds and ETFs and whatever. And then you, at an asset manager, you typically have your 401k or retirement accounts. And then you have your credit cards that you pay from your bank account. And each one of these things, the provider of the service is custodying you, right? So your equity position is separate from your bank account, is separate from your credit card, is separate from your retirement account, or separate from your cash. So think of a world where all of that financial services you custodied. And like, let's not just get into semantics of security. Just go down this journey for a second. If I had my stocks, my checking account, and my credit card, let's just start there, all in the same custody infrastructure. Right now, I'm never going to let facts get in the way of a good story, but the facts are pretty shocking that the amount of people in the United States, I think it's like 50 or 60%, that own more than 30 or 40K in equities have an outstanding balance on a credit card that they're paying north of 25% on. Okay. Now, why does that exist? Because in theory, and I know people promote this, and I think Robinhood's probably the best at doing this, you could take a loan against your stocks and pay down the 25% credit card and only owe Robinhood 4 or 5%. In practice, it is so cumbersome and so, because each of the pieces are segregated, it's almost, it doesn't happen because it's too cumbersome. Now, think of a world where all of your accounts are linked and you charge a credit card transaction. At the end of the month, you don't have enough in your account to pay it. So instead of taking the penalty fee plus the 25%, what if you had the ability to borrow that 2K against your stocks? So basically you pay the credit card bill and now you're paying 6% instead of 26%. Right, and then as the cash flow comes in the next 2 days, you pay down that loan whenever you have to. Right, think about that. How much money that saves somebody, and it's a term that I have to find. Maybe you can help me find something that's much more appealing across disciplines. But in trading, it's called cross margining. Being able to use the margin from one account to open up positions in another account. Right, so if you could cross margin your life, so many efficiencies come in. If you think about the interest that you're paying on these credit cards, the money you're going to save on that interest and redeploying that, That's thousands of dollars a year for someone who makes 50,000 bucks, right? Like it is, people, the amount of bundled financial transactions that if you just take all the debits and credits of your life and you stick it in a singular wallet that you control, then instead of you going to the bank to get a financial service or to a home lender to get a financial service, they can now look at you and come to you. They can bid for your services because once you sign up for financial service in this world, they own you. And it's so painful to shift from one brokerage to another, one bank to another. And that's built-in inertia. But you change the dynamics by allowing them to compete for you. And they don't have to now because once the retention rate on financial services is insanely high. It's probably up there with your cell phone provider. Or mobile phone, sorry. Does that resonate?
It does. I think because I'm also trying to find like the right analogy for a general user and like how that would work. I quite like yours. Like if you get the sense of just moving those funds in a different way, and then that's actually through self custody. But again, like we know these terms, and I'm wondering how far we can go and how much knowledge we can assume from the audience here. Talk to me about a specific case. So I think bridge loans, for example, we've sort of touched on. Payroll advances, we talked about, I think, a couple of weeks ago. Why can bridge loans for payroll advances come from another member of the same network rather than a bank? Like, let's use that scenario.
So that's a very live one. So we're piloting a new product that is going to allow earned wage access firms. So they're kind of a legal form of payday lending. So let me start there. An earned wage access firm is a firm that allows employees of large, low salary employees. So like think of a Walmart, think of a Marks and Spencer's, right? You have hundreds of thousands of employees who make the minimum wage.
Yes.
So in the past, they live paycheck to paycheck. They live intra paycheck to paycheck, right? So 78% of Americans live paycheck to paycheck. Within that, there's the stats are horrific around people who live intra paycheck. So if you're making $400 a week and something happens, you go to a payday lender to borrow that $100 to get you to work or pay for groceries, and you owe them $130 in a week, right? The interest rates are astronomical. So what earned wage access firms do is they sign up with the employer, and they sit between you and your payroll. So when you get this, it's typically a benefit a firm offers, like healthcare and dental and whatever else, child care. So you sign up for this service, and what the service does is it shows you how much salary you've accrued during the pay cycle. And at any point in that pay cycle before the payday, you can pay a fee of $3 to $5 to have them send all your accrued income. So it's a much more safe and cheap way for low-income employers to get access to their money. Now, in the U.S., we typically get paid once every 2 weeks. I think some of the low-salary employers in the U.K. get paid once a month. So it's a much more acute problem for the UK and others on longer payroll cycles. So what actually happens in the background? What happens in the background is when you claim your income, that EWA firm has to borrow the money from the bank to deliver, and then when Walmart's or Marks and Spencer pays them, they unwind the loan, right? That cost is at 6 to 9%. Then they have to make a 50% profit margin. So when you click to take your income, that's all baked in to the cost, right? And the cost is being driven primarily by the cost to borrow to allow that fake fintech service of immediate payments, right? So the structure that we have is it's addressing two problems. So the exam question is, how do I get that interest rate from 6% to 3%? How do I find somebody who wants to fund that? So we're piloting an earn program where, and we're particularly interested in positioning it in where people receive their payroll. So if you're a vendor or a consultant and you get paid via stablecoins via Deal, use as an example, will surface an earn program where you can deposit your excess until you need it into a earn vault. That earn vault sits for just-in-time loans to pre-vetted, pre-risk managed entities like earned wage access firms or remittance companies, where we know the money is coming from a AAA company or it's coming from the Fed itself through ACH, right? It's just the timing of payments. So when you use stablecoins, many stablecoin issuers will offer you some percentage of the NIM. So this combination of putting your excess stablecoins from your income in a vault that gets half the yield from net interest margin from the stablecoin issuer and half the yield from a commitment fee from the borrower, you've basically created a product where the user earns 6 and the borrower pays 3. We basically inverted the banking model, right? Where the user gets 0.4 and the borrower pays 6. So that's only viable because we have wallets, stablecoins, vaults, and blockchain.
It's all the tech. Yeah. Tell me about the other side to this, because 9% is egregious. I don't care. I just like this. Again, it's what people are willing to accept, but this is not about a product. Banking is not a product to me. It's just not. It's not a commercial product. It's not. It is a fundamental right that everybody should be able to bank, and that should not be set to a rule of how much will someone be willing to accept. How tight can we make these lines where people will still bank with us, will still use our services, will still build on top of it, and they'll just charge the user or the consumer, especially when it's someone going paycheck to paycheck. The idea that that's a choice, like my dog gets sick. Oh, okay. Now that wasn't an expense I accounted for. I've been doing my best to earn some savings, but it's not going to cover this. I need to go somewhere to get that money in. My car just had its engine blow out, even though it's just been serviced. We've all had one of those things happen to us, regardless if we're in that bracket, if we've ever been in that bracket. And even like for me, I'm fortunate enough never to have really gone that drastically to paycheck without like a parent or someone who would loan me the money and they wouldn't charge me the 30-40%. But I have been in a scenario where I rented a place and I was paycheck to paycheck for the most part, but I had a security blanket and I'm very privileged to have that, and I understand that. The idea that someone who doesn't have that then basically gets themselves into a snowballing scenario of debt just because a car engine has gone, a tire has burst that they didn't expect. That's not a choice. That's a fundamental right to be able to just say, hey, this is what I earn. We could also talk about why they're earning that little, but then we'll get maybe a little bit too political. But that to me, yes, it goes beyond the product and service. It goes beyond somebody in a boardroom saying, hey, we can probably push this line a little bit further. People don't seem to be blinking at it. It's wild to me. Talk to me about the other side, though, because there's that side, and then there is, at least from my understanding of like payday loans, because we had a big scandal blow up in the UK. There's also the risk. That's what they hide behind. People on lower end incomes, on paycheck to paycheck, there is a much higher risk that they won't pay the loan back, and that's also why they charge these extortionate fees, because they're not going to get every single pay back. So they need to then charge every user to mitigate the fact that some of these users aren't going to pay back. How does this model cover like the security side and the credit score side?
So I don't remember when the payday scandal happened, but I feel like it's been rolling in the UK for years. But payday, so I think EWA's earned wage access have evolved as a solution to the credit risk problem. Because in the old model, you bring in an old paycheck and you say, this is what I get paid every week. And then there's an independent lender who doesn't really have claim on your income, right? So that's why they charge these exorbitant rates, because the default rates are super high. What earned wage access has done is they sit in between the actual payer and the receiver, where the payday loans don't, right? They're doing some kind of credit analysis on you and then hoping you can pay them. So the risk is drastically reduced if your claim of funds. So the only way an earned wage access firm loses money is fraud, or that someone claims, like someone gets fired and they're not keyed into the system fast enough, and they're still showing a paycheck that they would never actually get in the real world, but because they have this service, they can claim it, but they were fired a week ago.
Yes.
Right, right. Like there's and the default rates on these things are below 1%. Right, default rates on auto loans are 20 times larger than this, and they're actually done at much lower interest rates. So like the default rate, that's how they solve. That's how the earned wage access firms solve it. But again, they're also solving it with a loan. So they're able to take where they can get the cash from at a lower interest rate. But like 9%, 9% is, let's put it in like things you can invest in. 9% is well below investment grade, more commonly known as junk bonds that are pretty close to default. Right? The investment grade universe is about SOFR plus 100, so call it 5%. And the sub investment grade is about 6.5%. Right? This is junk debt. So to get to 9, it is massively, massively risky stuff to get out there if you're just risk adjusting it. So I think the way this kind of evolves is that by upgrading the infrastructure of the rails and lowering the cost and just keep getting that down, because it's still, I'm going to tell you a sad fact and we can move on to the next thing. So you get, in the US, you get 26 paychecks a year, assuming you're on a 2-week cycle.
Yes.
This statistic is horrifying. The amount of people who use earned wage access, the amount of times they draw per year, which is on top of the 26 paychecks they get, is around 30 times.
It's more than the paychecks they get.
So yes, so they're basically getting a paycheck every week. And while the interest rate is somewhat hidden because it's a fee, it's $3 whether you take $10 or you take $100. So if you add $3 times 30 times is $90 on someone who makes 20 grand, that interest rate is astronomical. It's in the hundreds of percents on the money that's borrowed. So it's an even bigger tax on the people that can afford it the least. So if we can, there's only so many things you can do in life to make it better for people, but getting the cost structure down from the EWA provider will translate to cheaper costs for this lifeline.
This is, you said there's only so many things you can do to help people. I think this has got to be one of the most fulfilling versions of that, right? Like, really, I think the difference between this and some other solutions I have heard is they kind of tied up into goodwill in some way or another. They're putting pressure somewhere where someone has to say, we'll do this for the good nature of the fact that it will improve the planet, the world, that person's life outcome. This isn't that. This is just logically, there is a new technology. It means we can reduce costs and we can pass that cost on to the people who need it the most without anyone having to, change their outcome or make a gesture based on goodwill. Like, this is just fundamentally and factually the way it works.
I appreciate that it looks like, these type of services make you look like a good person or whatever, and that's fulfilling. But there's economic basis for this, right?
Yes, exactly.
The more people you include in the economy, the bigger the economy grows. And the best example is China. Why has China grown from the 10th largest economy to the second? There's a singular point, and we can debate there's a million different reasons, but look at how many people came out of poverty over the last 20 years to be in the constructive part of the economy. So they solved two problems. One, they did the altruistic thing of getting people up the income scale and the life scale, but the economy boomed on the back of it, right? Getting bank accounts to the unbanked, getting these financial services cheaper to the lower incomes puts them on a scale where they contribute back to the overall good, right? So there is a altruistic way to look at it, but there's also a proven economic system that benefits from doing these things. And by the way, if you think of the 8 billion people on this earth, way more of them will benefit from these services than won't.
Yeah, I love that. Talk to me about this final part of the article. The average credit card APR on interest assessed accounts reached 23%. This is directly from the article. 23% in 2025, with penalties near 28%. We've touched on this briefly, but not in the credit card perspective. Why does every cardholder subsidize the defaults of the least reliable one? Like, why am I with having never in my life not paid back debt, why am I being charged as if I'm still risky? I've done that for 20 years now. Never had a black mark against my name. Why would how somebody else behaves impact me?
So I spent a lot of time understanding how credit cards make money, and there's always this 3% fee on a credit card.
Yeah.
When you start digging into the way fintechs actually operate, there could be up to 30 different individual providers that take a piece of that 30 basis points. So thinking Visa makes 3%, I think they're at best making 20 bips, right? Like there's so many different people that eat out of that infrastructure that create a higher cost structure. And that is either political in nature, trying to build moats around local, supported businesses through the legislature, or fintech, technology gaps. But for whatever reason, there's a lot of people taking a cut out of these payment side. So if Visa was taking all 3%, then the cost of subsidizing their loan book, which is basically people who don't pay their credit cards, would be a lot lower, right? But there's so many people that eat out of the middle that they have a much lower amount. Let's be fair. If you pay your credit card bill on time, you're not charging this. But
True.
the idea becomes that this is another who gets taxed this. This is the K-shaped thing I was talking about before. It's actually a surprising, like the people who don't have money as a bridge loan. Most people who are taking payday lending aren't available to get credit, but if they are, they're that next rung up. And this is really their only lifeline. They just have to go to the credit card and pay 28%. It's actually better than the 200% they're going to pay in a payday loan. So like, for some people, this is an upgrade. But the thing that's starting to happen more and more, and the numbers are shocking, is why would you pay 28% on a credit card when you own $50,000 to $100,000 of equity, home equity, bonds, stocks? Like, well, shouldn't you just take a loan against that to pay, like a single-digit loan to pay a double-digit loan?
Yeah.
And it's because the infrastructure doesn't exist, or the way you do it is so cumbersome that people don't do it. And this feeds back into, if we have this singular wallet that you can cross-margin your life, people that have these assets, would it have the ability to save much more money or spend much less on this type of pressure? I mean, I can get into why the credit situation, but I don't think it's really relevant here. And I don't think it's mispriced, because no Wall Street bank would buy it much cheaper.
Yes.
So the default rates are quite high, because if someone's taking a 28% loan, they're much likely to default than someone who's taking a 4% loan.
Yeah. Look, we definitely need a part two of this. Love the article, guys. Definitely go and check it out. If you're not following Centaura, you're not following Anthony, please go and do so. I honestly think this article woke me up a little bit from my slumber as well. Like, it got me a little angry. I can tell that Anthony wrote it angry, because yeah, like it really is like, oh fuck, this is what the world is currently. Any final thoughts, Anthony, as we come to time here? Any updates, milestones, anything you want to share to people who have been maybe a bit like me during this article, where they are a bit more awake now, and they want to see what they can do, and they want to see what Centaura are doing to solve for this?
I just think that if you're using a traditional bank account and consuming through a traditional brokerage account, spend the time to look at neobanks, debit card offerings, ways to get cash back, ways to earn higher yield on your money. Like, do yourself the favor to reassess, do a spring cleaning of your finances, because a lot of these individually exist that'll be an upgrade to what you're doing right now. But then, vote with your feet as a consumer and demand these services, because they do exist and they can be offered. It's just until the consumer speaks up, status quo is always the best course for institutions.
Well, guys, I hope you heard that, and I hope you do look at these alternative options now. And yeah, I think we do need different words other than crypto, and we can talk about that later. But guys, that is all we have time for. Hope you enjoyed it. Go definitely check out the article. Go follow the accounts, and we'll catch you on the next one. Thanks so much for tuning in. And also, go like and retweet this post, because if people don't read, they can just listen. That's always an option too.